Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello, and welcome to Different Makes a Difference. I'm Stephen Boland from Odlum Brown. For almost as long as I've been investing, I've been a big fan of Warren Buffett. He's a great investor, a great manager, a teacher, a philanthropist, and over the last 60 years, he's built a very successful company called Berkshire Hathaway. And Berkshire owns businesses ranging from railroads, utilities, to Dairy Queen. Here in Canada, there's a company that's not quite as well known as Berkshire, but has some similar attributes, and it too has been very successful. That company is Fairfax Financial. And since 1985, Fairfax has delivered shareholders a 19% compound annual return, making it one of the best stocks to have owned in North America over the last 40 years. So today we're going to talk about Fairfax and why there's still money to be made. And with me to do that is Stephen Zicherman, who covers insurance, technology, and healthcare for Odlum Brown. Welcome, Stephen.
Hey, Steve, it's great to be here. You know, we often get to have lots of conversations at work, but now we get to chat and have a great conversation in a podcast form.
Great. Well, thanks again for being here. Let's start with an overview. What is Fairfax Financial, and why does it sometimes get compared to Berkshire Hathaway?
Sure. Well, Fairfax is an insurance company like Berkshire Hathaway, but both companies are a little bit different than your average insurance company. Both companies have an value investment approach. They're looking to invest their portfolio in companies they think can grow, which is unlike a traditional insurance company that just wants to match their assets with liabilities. But Fairfax, in essence, is simply a holding company, and through its various subsidiaries, it's engaged in property and casualty insurance. Most people know what property insurance is. This is insurance that helps to cover losses to physical assets like buildings or personal belongings. Casualty insurance is insurance that protects against legal liabilities that arise from accidents and injuries to third parties.
Okay. One of the interesting things about insurance businesses is the concept of float. Can you tell us about float and why that can make insurance businesses quite interesting?
Float refers to money that an insurance company holds between the time they collect a premium from a policyholder and the time they pay out claims. If you collect more than you pay out, then your float is a benefit, and you can use that additional funds to invest and generate additional returns.
Okay, so I imagine it's quite important to be good at underwriting, because if you lose money on the underwriting, you're offsetting your investment gains. But if you make money at underwriting, it's additive to your investment returns. What's Fairfax's track record been like on underwriting?
It's been excellent over the past number of years. It's been a really nice improvement since 2017, the last year in recent past, that they've generated underwriting loss. More recently, the insurance market's been described as a hard market. So this is a favorable market for insurance where there's a little bit less competition and there's an opportunity to charge a little bit higher premiums as a result. So over the last few years, their underwriting profits have increased.
What kind of investments does Fairfax make? Where do they invest this float? And can you give us some examples of what they own?
Sure. They invest in both private companies and public companies. Maybe one example of a company that now they own privately is Recipe. This is the company that operates several restaurant chains, including Swiss Chalet, Harvey's, and The Keg. They, from a public company perspective, they invested in Eurobank. They also have investments in other companies that are publicly listed.
I was always a big fan of Swiss Chalet, and out east where I grew up, it used to go there a lot, but I find them hard to find in Vancouver. But whenever I travel out east, I still like to have a quarter chicken dinner with the dipping sauce.
Yeah, the special sauce is great.
Yeah. Okay, so Fairfax was founded by Prem Watsa in the 1980s, and he still runs it today. I remember when I started in the investment industry, Prem was really highly regarded. He was seen as one of Canada's best investors. But over time, his reputation has ebbed and flowed. Can you tell us a little bit about that?
Sure. Prem Watsa, the CEO, is really a fantastic operator. We've always been attracted to companies that we call owner-operators, where the founders or somebody else who's running the company owns a significant share in the company. Prem owns around 10% of Fairfax Financial. They made some great investments in the early days. Value was probably a little bit more fashionable. Prem decided after the great financial crisis that they were going to make some more macro bets. They were hedging the market. They had short position bets as well. So the investment performance, the average investment performance was a little lackluster. I would describe this period as roughly a 5-year period between 2011 and 2016. I think they went back to their roots. They're no longer shorting indices or individual stocks. The equity purchases that they've been making have been much better, and I think they're going to have much better returns going forward.
What gives you that confidence that the returns are going to be good going forward?
Well, there's really no guarantee, but I really like stories, or I have a lot more patience for managers that have gone through ups and downs, that have experienced challenges, but have shown some resiliency. I'm a little bit more skeptical with newer managers or ones who claim they have a track record with no blemishes on that. That's more often hard to believe. So I think having gone through some adversity and rebounded from there gives me some confidence that there are a lot of lessons learned.
Right. And Prem has been doing this for a long time. And over the arc of time, he's been incredibly successful, which brings me to the question. He's in his mid-70s now. Do you have any idea how long he's going to keep working? What does Fairfax look like after Prem leaves? Is it a one-man show?
Yeah, well, we hope he continues to work for a long time. Warren Buffett recently retired in his mid-90s, so perhaps the runway for Mr. Watsa is long. We were recently in Toronto to visit the company and attend their AGM, and at the same time, we attended the annual general meeting for Fairfax India, where Mr. Watsa's son, Ben Watsa, is chairperson there. We were pretty impressed by the presentation he made. And I think over the long term, Mr. Watsa has noted that the company will stay with the family. I assume that his son will take over as chairman. Still, they have a great bench of professional managers that are running the various subsidiaries within the company. And interestingly, a lot of those managers have a very long tenure at the company. On average, I can point to people that have been there for over 20 years. So that gives us a lot of comfort that there's great strength, not only from the Watsa family, but also from the managers that are running the individual subsidiaries.
Okay, so a lot of talent there. I remember a number of years ago, you and I went to a Fairfax meeting together. What I remember most about that meeting was the culture. It really stuck out to me how admirable their corporate culture is. Can you tell us more about that?
Each year, they show the same PowerPoint slide chart with the same number of bullets about their fair and friendly culture. These really emphasize how it's a results-oriented company, not a political company, how honesty and integrity are essential in all their relationships, how they're hardworking, but not at the expense of their families, and also how they follow the golden rule. Treat others as you would want to be treated. I think the other thing I want to point out with respect to culture is that Fairfax is a decentralized company, meaning that responsibility is often pushed down to all the individual businesses. What we found over the years is that when we talk to management of companies that are decentralized, they often remark at how having ownership and accountability is a motivating factor and is also a really strong retention tool. When Fairfax buys into a company, they generally don't integrate acquisitions like other companies do. They leave them alone and let them operate on their own so that they can maintain that independence and accountability. And the last thing I want to talk about with regards to culture is share ownership and incentives. Annual bonuses to Fairfax senior executives are awarded part in cash and part in shares that vest over time. We think that's really great alignment as a shareholder in the company.
Corporate culture can have such a meaningful impact on a company and a stock over time. And certainly Fairfax's long-term history has been tremendous. When I look at the stock chart, what I see is that, in the 2010s, and you kind of referenced this a bit earlier, the stock didn't do a whole lot. But over the last 5 years, it shot up quite a bit. Can you tell us more about why it's done so well recently and why you still see upside from here?
Yeah, I think the sentiment with regards to Fairfax was quite negative 5 years ago. When we look at Fairfax's valuation relative to its peers, it trades at a slight discount to the average. And these peers include Markel, Berkshire Hathaway, and Chubb. Yet when we look at the growth potential, Fairfax is projected to grow faster than the peer group. So in essence, we're getting more growth at a better valuation.
Well, that's a pretty compelling setup. So lastly, and perhaps on a little bit of a different note, we made the comparison to Berkshire Hathaway earlier, and Berkshire's annual meeting was a few weeks ago, and I know you and I have both gone to Omaha in the past and attended, but this year we watched it online. The big news, of course, and you referenced this earlier, is that Warren Buffett is stepping down as CEO of Berkshire at the end of this year. He's going to stay on as chairman, but what else caught your ear this year at the Berkshire meeting?
I think that just the length of Mr. Buffett's track record is really incredible. And from my perspective, I think that he changed over the course of his career. I think he started off, his mentor was a fellow by the name of Benjamin Graham, and they were more deeper value investors. They were investors that were more driven by price. And Warren Buffett's partner, who's no longer with us, Charlie Munger, helped encourage him to focus a little bit more on quality. So they were willing to pay a little bit higher price to own something that had more durability in the context of its competitive advantage. And just to see how an investor could adapt to changing conditions and remain flexible over a multi-decade period is something that really left me in awe. And I'm not quite sure if anyone's going to be able to generate a 20% compounded annual return over such a long-term time frame ever again. But nonetheless, the adaptability, flexibility is really impressive from my perspective.
He's a remarkable individual. And for me, I always love listening to Buffett speaks. He talks about doing the business the right way with high integrity and a long-term focus. I like his life lessons: do what you enjoy, spend time with people who make you better rather than bring you down. For me, it's not always earth-shattering insights, but it's simple reminders of how to invest better and how to live a better life. And to bring that back to Fairfax, I hear some of the same things from them. So thank you, Stephen, for being with us here today and sharing some background on Fairfax. It's a real Canadian success story. They've built a good insurance business. They're good investors. The founder, Prem Watsa, still runs the company, and he's built a tremendous culture. And despite a stock that's done well, there's still room for more upside. Thank you, everyone, for listening. We hope you enjoyed this podcast. If you hit the subscribe button, you'll get notified of future episodes, and we look forward to chatting again soon. Thanks again.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.